An analyst you've never heard of cuts their rating on a stock you own from buy to sell. The stock drops 8% before lunch. Your feed is full of people saying it's over. Should you follow the analyst? Ignore them. Most retail investors don't know what an analyst note actually contains. They just see the rating change and react to the headline. Today I'm going to show you how to read any analyst downgrade using 3 AI prompts and find out whether it actually changes the investment case. Welcome back to the AI Portfolio. I'm your host, a CFA charter holder with years of professional market experience. This channel gives everyday investors the same tools and thinking that used to be reserved for institutional desks, free every week. Nothing here is financial advice. This is a research skill. Let's build it. Analyst notes are research documents published by investment banks and research firms, Goldman Sachs, Morgan Stanley, JP Morgan, and hundreds of smaller shops. Each analyst covers a set of companies and periodically publishes updates that include a rating, buy, hold, or sell, and a price target. A downgrade means they've lowered their rating, typically from buy to hold or hold to sell. But what most investors don't realize is that the rating is the least important part of the note. The reasoning behind it, what changed in their model, what risk they're newly pricing in, is what actually matters. Most full analyst reports are behind paywalls, but the key content almost always leaks into the free world within hours. Financial news sites like Seeking Alpha, Bloomberg, and Reuters publish summaries with the core thesis. Many brokerages, Fidelity, Charles Schwab, TD Ameritrade, provide their clients access to analyst reports directly. Search the ticker plus Analyst Downgrade to find the note. You don't need the full PDF. The thesis, the new price target, and the change estimates are almost always quoted in coverage. Paste what you find into Chat, GPT, or Claude. Prompt 1. The thesis extractor. Analyst notes are often long, 20, 30, even 40 pages. They're also written in dense financial jargon designed for institutional audiences. The first thing you want AI to do is strip away everything and tell you exactly what is new. Use this prompt. Here is an analyst note downgrading company X. Identify the single core reason for the downgrade. Is this a change in the company's fundamentals, a valuation concern, a macro headwind, or a change in competitive dynamics? Then tell me, is this new information the company has disclosed, or is it the analyst's own interpretation of existing data? Finally, what specific metric or event triggered the change in view? This is the most important question you can ask. An analyst downgrading because of a miss that management already flagged is completely different from an analyst downgrading because they believe the company is losing market share and the company doesn't know it yet. Prompt 2. The estimate revision checker. Behind every rating is a financial model. When an analyst downgrades a stock, they almost always cut their revenue or earnings estimates at the same time. How much they cut and what they're cutting tells you how serious the concern actually is. Use this prompt. Based on this analyst note, what changes did the analyst make to their financial estimates? Specifically, did they cut revenue estimates, earnings estimates, or both? What is their new price target and how does it compare to the current stock price? What assumptions are driving the lower estimate? Is it a volume problem, a pricing problem, a margin problem, or a multiple compression argument? And how do these new estimates compare to the company's own guidance? If an analyst cuts their price target from $90 to $85 on a stock trading at 70, that's actually a buy signal hidden inside a headline downgrade. If they cut their target from 90 to 50, that's a very different story. The numbers tell you what the words won't. Prompt 3, the consensus mapper. One analyst's opinion is just one data point. The more important question is whether this downgrade is a leading indicator, one analyst seeing something before the rest of the street does, or a lagging indicator, the last analyst finally giving up after everyone else already moved. Use this prompt. Based on this analyst note and any available information about Wall Street consensus, how does this analyst's new view compare to the broader analyst community? Is this analyst ahead of consensus or behind it? Does the note reference any upcoming catalysts, earnings, product launches, regulatory decisions that could prove the thesis right or wrong in the near term? And what would the analyst need to see to reverse their view back to a buy? That last question is one of the most powerful in investing. Understanding what it would take to change the thesis tells you exactly what to watch for and gives you the information you need to form your own view. Those are your 3 prompts: thesis extraction, estimate revision, and consensus mapping. Together they take a headline downgrade, which looks like bad news, and turn it into a set of specific, testable questions. Is the concern fundamental or interpretive? How much did the numbers actually change? And is this analyst early, late, or right on time? One thing to always remember: analysts are often conflicted. The same banks that publish research also run investment banking businesses with the companies they cover. That doesn't mean their research is wrong, but it means you should always ask why they're publishing now. A downgrade published the day before a lockup expiration is very different from one published after an earnings warning. Context matters as much as content. Your homework this week: find any analyst downgrade from the past month on a company you follow. Run all 3 prompts. Compare the analyst's new price target to where the stock is actually trading. You might be surprised how often a headline downgrade is actually neutral, or even quietly bullish. Subscribe if you haven't already, and I'll see you in the next one.